And here we go. Good morning. I am being told that I am live. So, welcome to another Money Matters episode. We're going to try something brand new that we haven't done before, which is basically trying a different microphone to see if I could eliminate that weird echo that we've been hearing over the last few days. I am beyond excited to share with you today what I have uncovered when it comes to market prices. We're going to be covering anything from gold and how gold is performing, obviously, other precious metals. We're going to look at how the stocks are doing, what's going on in the world of cryptocurrencies, and then we're going to finish with sort of what's going on in the real estate market and my predictions. So stay tuned. This is going to be an excellent episode, and I am beyond excited to go through it. And welcome to another episode of Money Matters, only here on onedealaway.com. I am super excited to share with you some of the information that I have been able to uncover. And so let's go through market overview, like what's going on when it comes to precious metals, when it comes to stocks, when it comes to crypto. And then we're going to cover some of the very important news and things you should consider if you are in real estate market, or you're thinking about potentially investing, getting in, getting out. Like, what should you do? And if you're a company thinking of commercial space or owning a commercial space, what is everybody else in the market doing, and how are we going to uncover that? And that's all coming to you today live only on One Deal Away. So 2 months of new currency circulation could buy a stunning amount of silver and gold. So let's take a look at kind of what's been going on when it comes to the markets and when it comes to, really folks that, looking at the money that has been printed. I mean, there was that meme that says money printer goes burr. Yeah, I think that that's absolutely what's going on. But let's talk about it from the perspective of like the amount of money that has been printed. How much precious metals could you buy? So according to St. Louis Fed, currency in circulation increased a staggering 122 billion from March to May. That's like 2 months. The chart below, we can see the annual increase in the U.S. Oh no, this moves a little bit too fast for me. Increase in U.S. currency in circulation range between 80 to 100 billion per year. However, the Federal Reserve increased the total currency in circulation by 122 billion in just 2 months. And this right here is basically what that is showing. So it's kind of showing total, annual kind of currency in circulation. So it turns out that to be astonishing amount of silver, nearly a decade's worth of global silver production, right? So what they did is basically took 122 billion to buy basically silver at $16 and $1,600 for gold. They missed the mark a little bit. Well, at the time they did it, they probably didn't miss the mark at all. Let's be honest. But probably right now they are missing the mark, because I will show you that the prices have shifted a bit since that time. But I think it sort of shows something very interesting here, that the amount of money that we printed in a course of 2 months, what it could potentially buy when it comes to precious metals, and how long does it actually take to produce this stuff. So that was a really interesting piece. The 122 billion in new U.S. currency in circulation would equal the value of 9 years of global silver mine supply and 9 months of global gold production. And this is just the increase in physical Federal Reserve notes, mostly of $100 bills. So this next chart kind of shows of the currency in circulation with the $100 bills. And it says, according to the Federal Reserve, a most recent chart of the total 1.6 trillion of currency circulation at the end of December 2018, $100 bills accounted for 80% of the total. So what they're saying is that this 122 billion is not like the full amount of what's been put in circulation. That's just $100 bills. In less than a year and a half, total U.S. currency in circulation is now 1.92 trillion, up from 1.67 trillion in December 31st, 2018, and nearly half of that 250 billion increase took place in the past 2 months. And here's the chart directly from Fed. And for some of you that might be new to looking at some of these Fed charts, you may not necessarily understand what these gray lines are. So if you do, my apologies. But if you don't, these are basically recessions. And you will see that the liabilities and capital, basically the currency in circulation, has been kind of going up. And you will see some sort of bumps and kind of coming down. And then you will see that since we had this 2008 crisis, that the prices really have prices that the currency in circulation has been going up. We had this little tiny drop over here, and then it just went like almost vertical. So they're basically saying that, like, yeah, the trend line is virtually heading straight up. So one of the things to kind of pay attention to. Now let's switch over to gold prices gain as recession looms over and economies reopen. So, gold basically has gone up. And so spot gold rose, 0.5% basically, to 1738 per ounce as of this was actually, when was this? May 19th, and today is May 20th. So this is basically yesterday's news, so to speak, but we'll be looking at the market and kind of how that might have changed. So fundamentally for gold, it's never been in history, right? And so they are basically saying, let's get rid of the Facebook thing. Fundamentals for gold have never been better in history, pending that the big pandemic thing doesn't sort of stop and go away, and it doesn't look like it will. Any news of a setback of reintegration of business into economy will ultimately lead gold higher. And they're saying that basically the driving demand for safe havens, where fears were kind of deteriorating in China-U.S. Relations, with NASDAQ set to unveil restrictions that will make it more difficult for some Chinese companies to list there. So it's going to be a bit more challenging to buy Chinese stocks if that's what you're looking to do. And of course, NASDAQ focuses mostly on tech. But as the U.S. stocks edged lower, some people kind of took the profits, and what they're saying is that Monday's jump in equities and oil had caused the gold to retreat. But right now, market is focused on aftermath. However, they're saying the underlying demand is still not going away. Palladium had gained 1%, then platinum jumped 1.8%, and silver is up just short of 1% to 1731. So if you remember in a previous report, they were talking about $1,600 gold and $16 silver, and of course the prices have actually jumped. So that chart that you saw is going to shift because of the prices that are shifting. Let's continue on with the gold stuff. I promise we're going to focus a little bit more on precious metals today, precious metals and real estate. So we're really looking at physical assets today. We're going to see all of the prices and stuff. I'm going to cover that in just a moment. But for right now, we're really focusing on some of the physical assets in this particular episode because, it's important to get a global perspective and kind of understand of which assets perform the best. And if you're watching this on YouTube or elsewhere for that matter, you are missing the live show. If you want to watch live, and I highly recommend you watching live, you can only get that by joining us at onedealaway.com/live. All right, let's continue. So gold continues to outperform S&P 500, and I'm going to be sharing with you something incredibly important of what's going on with S&P 500, which is the triple top. So those people that have been calling a W, right? This is what a W looks like. They might be right. They might be right. So let's see. Only time will tell. Uh, it is not surprising to see mainly outflows from equity funds, while bond and gold funds benefited. Businesses are forced to work from home anywhere and utilize more bandwidth than before. This is going to be incredibly important when we switch over to real estate, and I will explain why once we get to that particular segment of the episode. For the week, S&P 500 lost over 2%, while gold gained over 2%. And 2% doesn't seem like a whole lot to individuals, right? Because, for some of us, 2% might be like $2. right? Or $2,000 or $20,000 or even $200,000 for some of us. But for the market that is in trillions or even billions, 2% is a nice chunk of change. So just keep that in mind when you look at some of these percentages. It doesn't sound like a big deal always. Investors are flocking uh, to the precious metals in droves this year. Gold has been an attractive investment this year, with global monetary printing now well over above $10 trillion when you consider both monetary and fiscal boosts. Gold has historically been a hedge against black swan events, and after a market crash and subsequent rally, gold seems to be safe haven of choice in the last 3 months. S&P 500 index funds had significant outflows, losing a cumulative of 7.36 billion. So remember when I told you that people are exiting and it's only like 2%, like we're talking billions of dollars, right? Tech continues to rally in the face of pandemic, but I think most people expected that. And if you're watching some of these sort of stocks and kind of what's going on, you've noticed that places like Amazon, Zoom, and that kind of stuff has benefited quite nicely throughout the pandemic. And while everything else was crashing, they were actually performing really well. However, I would argue that some of those things are still incredibly overpriced. Although if they are delivering goods and people believe that they're going to grow and the, their revenue is going to go up, that might change. And so sometimes you can't always trade on the fundamentals. Although in my personal opinion, it makes sense. Sometimes you have to look at the technical of what's going on and the sort of uh, the feel of the market of what people think is going to happen, and everything is really based off of the behavior of investors, of consumers, and everybody else. With the Federal Reserve set on easing mode for the foreseeable future, bond funds are also caught some inflows this week. Investors have looked to play volatility in the stock market. So we'll look at volatility, we'll look at the bonds as well in just a few moments. Global funds struggled to gain grounds this week as investors took to favor US based investments. And this is that part of that, there's everything is ugly in the markets, but U.S. still seems to be doing quite well. Uh, Bank of America poll shows investors doubt the stock market rally can last. And this is a good intro because right after this, we're actually going to look at the prices and kind of what's been going on with the charts. As you know, I really like charts because it paints a nice picture of what you can see, and we can see trends, especially when you zoom out. When you zoom in, that's incredibly good if you're trading, especially if you're a swing trader. However, when you zoom out, you can see a nice trend, whether it's going up, down, or sideways. And we're going to see all of that stuff in today's show. So let's get to it. So here we go. Bloomberg. Global stocks may be up almost 30% from their March lows, but most fund managers in a Bank of America Corporation survey remain skeptical that the gains can last. 68% of investors call the rebound in equities a bear market rally, or sometimes called suckers rally, right? So because the suckers kind of jump in, or a short-term and fast bounce of stocks before they fall to new lows. 75 who predicted a U or W shape rebound are basically saying 75% are saying that it's going to be U or W, and you will actually see that W. I will show you that in a short while. Global growth expectations surged in May, while net 38% of fund managers predicting the world economy will strengthen over the next 12 months. So what they're basically saying is that, yeah, things are going to get better, but you're going to wait a little bit before that happens. Investors don't see global manufacturing PMI rising beyond 50, which is the level that signals expansion before November. So it's going to be a super slow summer, but I think all of us know that. Like if you've been paying any attention whatsoever, this is not really news to any of us, right? A small reduction in cash levels from 5.7%, which is still above the 10-year average of 4.7, while bond allocation jumped to the highest since 2009 financial crisis. So again, it confirms that whole component that people are sitting on more cash and people are getting into the bonds because all of this printing and inflation, bonds tend to perform really well. So that's one of those things that we're seeing, and one of the things that I had recommended for folks back in February to switch over to bonds and kind of hold on to it because, I saw this big old thing coming. And for some of the folks that lost some loss, yeah, they have prevented some losses. They lost some losses. No, they prevented some losses. Um, so many traditional fund managers have been saying staying away from the risk assets. Risk assets are basically stocks, a glimpse of which market players have been driving the rally in stocks. Hedge funds this month boosted their exposure to equities to a net 30%, a 34% long position, meaning betting the market is going up, bringing their allocation close to the levels seen before the February market collapse. B of A polled 194 fund managers overseeing 591 billion in assets during the survey. So this part is interesting that we're seeing some of the hedge funds boosting some of the exposure. I think they're going in and playing with it, but they're likely playing within the swing trades. And you will see that there were some great opportunities for swing traders. All right, let's do this thing. Oh no, I have to zoom out, y'all. I had to zoom in. Every time you switch over from different sites, some of them are super tiny, you can barely see it, and then some of them are like super big. So here we go, crude oil. As you can see, crude has actually, like gone like super low down here. And since then, we have been actually kind of chugga up. This is a 1 month. Let's switch over to 1 day view. Oh, it's not available. Wow, interesting. Okay, but I wanted to show you 1 month because I think it's important to kind of see the trajectory. And you can see that crude oil is actually kind of going nicely up. Let's go on with the gold. We just talked about the gold. You can see the gold is kind of interesting. It has gone up, then we've seen sort of the down piece, and it's almost like the cup formation when things are consolidating. We're just expect to go up, but then we had this like down piece, and now it's kind of going back up. If we actually zoom out to 6 months, you can see kind of how it's been performing. We had this slump in March with everything else. Then we had a big rally, and it's kind of been going up. So you can see from March that if you look at the channel, it's and I can't draw in this one. I should have chosen a different way to view this thing, but I wanted to use Yahoo because most people use that stuff to kind of take a quick glimpse. You can see that the high is sort of like gapping or gapping. It's sort of a slowing down, and it's almost like hitting the top right over here, and it's starting to trade almost in channel that you can see in here. So it's kind of going a little bit sideways right now. So we'll see if it will break. Okay, silver. Silver actually has done really well in the last month. And if we look at the 6 month, you will see that it kind of dropped down and it's slowly gone up. We have this nice U cup formation piece and it's going up. So I think silver, some of the people, I was told that Peter Schiff has been calling that silver is going to be a great trade now. And the chart seems to be confirming that story. So something to consider and pay attention to. Treasury yield. So this is 1 year treasury yield, and you will see it kind of has gone down. Then it went sideways. We dropped. It went up, and now it's going back to sideways. Let's zoom in to about 6 months, and you will see very clearly that the yield is not all that high. Ooh, that's a little bit too much. The yield is not all that high, but it's forming sideways right now, and so that just basically means it's kind of sitting steady. You're not going to gain a whole lot by sitting in bonds, but bonds are not. Yes, you can make a lot of money in the bonds in specific markets, but with the super low returns, and this is a 10-year treasury, it's basically just kind of holding on to the stuff. So not a whole lot of gains, not a whole lot of losses, just kind of sitting in a channel. This is that sort of sideways market as well that we just talked about that you'll be able to see. Okay, volatility index. Volatility index has been interesting. Let's zoom into the year. So not much happening, not much happening. Then we hit over here like February, March. I mean, this thing went to the roof. And then it's kind of been slowing down with some sort of peaks here and there. So this is the part of some of the swing trading that, could be sort of interesting to go. But you will see that the overall trend from March actually has been going down, although snowing. And if you look at the month, you can see we went down, we gapped down, and then it's sort of staying steady, but right over here you can see that it's picking up. So it could be potentially a good time. If we zoom in one day, it could be a good time to get back into some of the volatility that we might be able to see. So now it's time to get into the index. And here it is, S&P 500. S&P 500 is very interesting. Let's zoom out to the 6 months so you can kind of see what's going on. We've, of course, dropped. Since then, we've kind of gone up. But this is part of that piece that I've been talking about for forever, even back in March, that we're going to see an up and sort of like slowing down and then right back down. So I'm going to zoom back into the month. And this is the sort of the W. You have a top right here. Pay attention. Then you have a bottom. So W, right? If you look at the W, you have a top, you have a bottom, you have a top, you have a bottom, you have a top, and then it goes down. So top, bottom, top, bottom, top. Guess where it's going? It has to go down. So if you're an S&P 500, not financial advice, but just something to pay attention. You can see kind of how it's definitely turning down. One day, this is of course yesterday, because the markets are not open because we're so early, and we're doing this early at 7 a.m. every single morning at onedealaway.com/live. And we're doing this because something like this, if you were to watch it at 5 p.m., well, it's not serving you at all. But if you watch it today, you might have an opportunity to kind of get out as soon as the market opens. All right. And again, not a financial advice whatsoever. You got to do your own research and your own sort of thinking about what makes sense, but that's just sort of where my view is and what my thinking is. Okay, let's look at Dow Jones Industrial. So this is the 1 month, and again, it's kind of sideways. It's not as ugly as S&P, but Dow has been ugly for forever, and you will actually see that maybe this is one of those things where we had an up and a down, and up and a down, and up and down, and slightly up-ish. So here we go. Top, bottom, top, bottom, top. Sorry, top, bottom, top, bottom, top. And again, I expect that it's going to go on into bottom. It's not as clear as S&P 500. And again, you can see it turning down. So something to pay attention to. Look at this channel right over here, y'all. So again, not a financial advice. Do your own research. NASDAQ looks a little bit better, a little bit healthier, but NASDAQ is mostly on the technology. And you will see that the overall, when you look at it, it's kind of going up. It's not like super steep, but it is going up. If we zoom out to 6 months, you will see we had a drop and kind of like a, I don't want to call it healthy because I don't think that this is necessarily healthy, but you can see that it is kind of going up. And if we go back to the 5 day, it's been going nicely. But again, here we go. In the last day, yesterday, it started to sell off. So today is going to be a very interesting day. Whatever you decide to do, make sure you are being smart about your money and put in those protective stops so that you don't get killed in the market. All right, let's look at the Bitcoin and how Bitcoin is doing. Here is Bitcoin 1 month. We had a halving already right around here, and we've been nicely chugging along. So if we zoom into a 1 day, it's sort of like not much happening, right? Like we had this little bit of a drop, then kind of sideways. And, this is one of those interesting ones. This one doesn't give me a 6 month component, but it does give me 3 month. Just to kind of zoom out and see it, if we look at the full year, you will actually see the performance and kind of how it's done. We had this drop over here. We recovered almost to the highs of where we started the year. So overall, doing pretty okay. Ethereum, here it is. It's been going. We had a drop. It's been actually performing rather nicely again. 3 month. If you take a look at it, as soon as it loads, it's not necessarily reaching those highs yet again that we've seen maybe in Bitcoin, but there's a potential, and you have to understand that with the crypto market, when there's a boom within crypto, everything tends to go up. So we might be able to see some of that change as well. And let's look at the final piece of the crypto, and that's XRP. And the reason I'm choosing Bitcoin, Ethereum, and or ETH and XRP is because those are the three top markets within crypto. They're the largest cryptocurrencies in it. That doesn't necessarily mean that all of them are good or all of them are bad. I'm just showcasing some of them. So don't be going out and just buying something because you saw it on some sort of channel somewhere. And if you're watching on YouTube, you're missing the live thing, potentially ability to benefit from some of the stuff that we share. Because one of the cool things about Bitcoin is that it's a 24/7, 365 market. It never goes to sleep, so you can trade it all the time. So when you learn something, you can go in and put in a trade right away. If we look at over the 1 day, you can kind of see it's sort of like kind of sideways. I mean, it's been trading sideways for a little while. There's not much happening with XRP. Overall trend, as you see it, has been kind of down in a year view. However, it looks like we have maybe hit the bottom, and now we're sort of starting to trend on up. Again, not a financial advice, just something that I'm seeing. All right, let's switch over to housing, my favorite topic in the world. Let's talk about what's going on in real estate. How should you think about it? Should you invest in real estate? Should you not invest in real estate? Like, what are some of the things that are going on, y'all? And this is going to be super, super important for you if you have a home, if you own properties, investment properties, Airbnb, long term rentals, if you are thinking about getting into real estate, if you have commercials. These are the things that are going to be incredibly important for you to understand. So let's dive right into it. And remember, you can watch it live anytime on onedealaway.com/live. All right. Here we go. U.S. housing starts permits plunge to 5-year lows. This is from Zero Hedge, which you can see. Analysts expect further terrible weakness in both housing starts and building permits. Housing starts fell 30.2% month over month, which is a record drop, and building permits fell 20.8% month over month in April. So you will actually be able to see the charts, and basically you can see that there's these records. When it comes to it, I want to say that this is housing starts right over here, and this is the building permits. So building permits are not necessarily at the lowest ever. 2008, 2009 was the lowest ever, but the starts are, really, really low. So one of the things that here is the another chart of the starts with the lows since February. So you can see that things are kind of slowing down. Multifamily starts dominated the drop. And there makes sense for that because multifamily is considerably a lot more expensive than a single family home. I mean, think about it. In a single family home, you're building something that is maybe like 1,200 square feet, whereas if you're building a 200 apartment building, we're talking like tens of thousands of square feet, if not more, depending how big the units are and kind of how spread out you are. So it makes perfect sense to me. Down over 40% to the lowest since April 2013. Single family starts were down 25.4%, lowest since March of 2015. So yeah, everything is kind of going down, which we've expected, but this is going to be an interesting piece, and I will explain why in a moment. Single family permits plunged 24.3%. So, again, it's more or less the same stuff. It's plunge, plunge, plunge. Applications to build our proxy for future construction, and the biggest drops were in Northeast and West. So, what does this mean, right? Because you can all look at the news, you can all look at this stuff, but that doesn't necessarily matter. Like, what does it all mean? What does it mean when the building starts and permits and stuff are not happening? That means that over the course of a future, kind of, let's look at sort of the life cycle of uh, what all of this looks like. So when I want to build something, right? It's not necessarily like I just go in and build it. I have to put in for permits and to actually start building stuff. So to get a permit and to get started, there is a chunk of time. Sometimes it can be months. Then when I start, before I actually get the finished product, we're talking additional months. Sometimes it can be a year or longer, depending on the project, the weather, how long it takes, how easy or hard it is to conduct a business in a particular area. So what this basically means is that in upcoming year to 2 years, we can expect that less things are going to be built. When the supply shrinks, demand stays the same, the prices actually go up, right? Simple supply demand thing. So that's one of the signals to kind of pay attention that at some point in the future, not potentially today, but at some point in the future, we could expect that the prices are going to start going up in real estate. However, we got to consider what's going on today, and that is exactly what we're going to see right now in this Market Watch report. Over 4 million Americans are now skipping their mortgage payments. And this is as of May 19th. So, again, yesterday's news. But I did think it's important because, in real estate, things don't move as quickly. They're a little bit slower market, which is quite lovely. It gives you an ability to react as opposed to like crypto or stocks or that kind of stuff where things are moving all the time and you got to like constantly watch it. This is a little bit easier. You got to still constantly watch it, but you have more time to react. That's the reason why I really like real estate. It gives me more time to move. I'm a little bit on the slower end of things. Fewer Americans are calling their mortgage services to ask for relief for mortgage payments. So that's the nice piece. What we're seeing is that forbearance is actually starting to go down. However, there's a lot of people, more than 4.1 million, who are right now in that plan. Signs suggest the homeowner prospects have improved, which is quite lovely to hear. Overall, 8.16% of all mortgages were in forbearance as of May 10th, which is up from 7.9 as of May 3rd. So we're still kind of have gone up. I think that is going to continue somewhat, but the requests are dropping from 0.5% of the total to a third of a percent of the total. So that's kind of a nice piece to see that it looks like things are slowing down. And we're seeing that in unemployment numbers, even though they're still coming at really high rates, the pace is slowing down. This is also showing that things are slowing down. More than 11% of Ginnie Mae loans are in forbearance, but these loans tend to go to borrowers who are first time with weaker credit. So this tends to be a bit riskier group of folks. And these are people who have a bit more exposure to the economic downturn. They typically tend to pay higher interest rates as well because better the credit, lower the rate that you get, which I think most people know that, but not everybody knows that. So I figure I might as well say that because it is important. I don't want anybody to feel like they don't know what's going on. A recent report from UK-based economic forecasting firm Oxford Economics estimates that 15% of homeowners will fall behind in their monthly mortgage payments. So what does this actually all mean, y'all? Like, what does this actually mean? It means that, if we look at the markets that the home starts are slowing down, right? That says prices will go up. Then we look at the inability of folks to pay, and that there are some research that basically says 15% of people will have to go through some foreclosure. That says the prices might go down. We're also seeing the reports that there's less homes for sale, but that the buyers are more or less like it has shrunk, but there are quite a bit of buyers. And as we're reopening economy, more people are wanting to go in. So that basically is telling me, I could be wrong, but it's telling me that in a short term, and short term in real estate is not like a week. Short term in real estate is we're talking like 6 to 18 months, is going to go down. So the prices are going to go down, and then maybe 18 months from now, 24 months from now, and so we can actually see the prices start to go up. And it's also going to depend on where you are in the market. Real estate is very localized. So while prices are taking a dump in one area, say like, for example, like say the prices go down in San Francisco, which one of the angel investors from Silicon Valley is predicting is going to happen, it could be going through the roof in place like Austin, Texas, for example, where people from Silicon Valley move to. So you have to watch for movement of people. Where are they going? Where are they leaving? And where are they moving to? and then also take a consideration of what's going on. So that's one of the things to pay attention. So when I'm talking about very globalized view of the whole thing. But when you're going out to invest, it makes sense for you to pay attention to the specific market that you want to invest in. Make sense? All right. So, mortgage regulators to loosen refinance restrictions for home loans and forbearance. This also came out yesterday, which is quite interesting. So, Federal Housing Finance Agency, FHFA, has issued a new statement, new regulation that people who are in forbearance will actually be able to borrow money and refinance. Right now, the rules are basically saying that you can't do that unless you kind of catch up, pay for at least a year, and then we can talk about refinancing and new homes and that kind of stuff. Now they're basically saying that if a family has been granted an ability to skip mortgage payments but then continues to pay them, or reinstated a loan, mean they caught up to the whole piece, they will be able to borrow again for a new loan or refinance. And it's at 3 months after the forbearance stops. So say that you've been in forbearance for months of April, May, and June, for example, right? July comes in, you catch up, right? And so it's July, August, September. So really where we can see some of these folks going in to actually try to refinance and move some of these things, it's probably going to be October, November piece. What does this mean? Well, this means that the rates are probably continue to go down. Again, my opinion, not a fact. Rates are going to continue down. So prices are going to go down. Rates are going to go down for this short period of time. So right now, this summer, y'all, and into the fall, you may have an opportunity to get some amazing deals at super low financing and low prices. So this is one of those things that I have been talking about back in March. People have actually gone in and asked of like, what do you think is going to happen, Nav? Like, where do we think we're going with the real estate? When is it going to be a good time to go in and buy? And I said, probably sometimes late summer and into the fall. And it appears that my prediction back in March is turning to be true. So if you have been waiting to get in, your opportunity might be coming in. So keep on working on getting those credits up, because you don't want to pay the higher rate if you don't have to, right? Get your cash position going and get ready. Start looking at stuff. Don't be waiting for August when you want to buy. You got to start looking now. You got to start learning now. Education is key component to being successful and being able to call on these markets and not to depend on any talking head, including my own, on whatever channel that you're following. You got to make your own decisions, y'all. And the best way to do that is to learn. You got to educate yourself constantly and consistently, and some amazing deals are going to be coming in from the regular market, right? Like on market, as they call it, that you can find through your realtor or Zillow or Trulia, whatever it is that you're using to find places, driving around and looking at the posted signs. Off market stuff is going to go through the roof. Tax sales are going to be amazing, y'all. Like, we are entering the period where you can buy things that were selling for like millions of dollars for 10,000, 20,000, so like in tens of thousands of dollars. It is going to be absolutely insane. And if you're saying, it would be kind of nice to own a $1.6 million property for 10, 20, 30,000 dollars. Where the heck do I go? How do I learn to that stuff? I'm going to do a shameless plug-in of check out Real Estate on the Cheap Challenge. It is a challenge where I teach you in 3 weeks, I teach you how to buy these properties, how to research them, where to find them, what you need to think about, how to prepare for those auctions, how to set up the money, and a whole lot more of like once you buy it, like how you can benefit from it. And speaking of that, I actually have created a video series that I'm going to be showcasing on my website, because this weekend I have to travel and deal with some of the stuff and work on some of the projects and businesses. So I won't be able to do the live stuff. My apologies. Sorry, y'all. But I did prepare special video series of how to get into the real estate So it's going to be 3 videos airing on Friday, Saturday, and Sunday mornings only on onedealaway.com/live. It won't be live. It's already been pre-recorded, but it's an educational session. It's a study session, as I like to call it, where you're going to be able to learn very basic components of how to get into the real estate at super low prices, then how to finance it to be able to pull the cash from the equity in a smart way, and then down the line, as you actually gain some of the equity within the place, and you are able to start trading up and look into things, because as the market moves, and it will move up, y'all, it will move up. It's going to take a little bit of time. How to actually take your profits, take your cash, move into some amazing properties without paying any tax whatsoever, like zero tax on all your gains. All of that stuff is going to be delivered to you on onedealaway.com/live this weekend. All right. Cool. All right, let's continue. I get very excited, y'all, about real estate, in case you can't tell. So, study paints bleak picture for job recovery. 42% of layoffs will be permanent. Now, the reason I'm actually sharing this while we're talking about real estate is because real estate is only as good. I don't know why this happens. Like, go away, man. Uh, all right, maybe if I zoom out, I can't make it go away, but at least we can see what's going on. So, the reason I'm talking about this is because real estate and rentals are only as good as the people who have jobs and are able to pay for stuff. So researchers from the top economic school in the United States are warning that they estimate 42% of the 36.2 billion Americans, which is actually 40 million, not billion, geez, 40 million Americans who have lost their jobs over the past 10 weeks will not regain their jobs. A shift in some major corporations are hiring. Rhode Island, the hospitality industry is being hit hard, which I think is everywhere around the nation and around the world. And numerous restaurants have already declared that they will never reopen. There are some places that are hiring, like Walmart, CVS, Amazon, like that kind of stuff. But vast majority of areas are not quite yet. China's economy shrank 6.8% in the first quarter of 2020. Eurozone economies shrank 14.8%. And the U.S. economy shrank at annualized rate of 4.8 in the first quarter. And many analysts project it will shrink 25% for the second quarter. So that's one of those things that is interesting to kind of see. But vast majority of the jobs won't be coming out to the market. So here we go. What does Robert Herjavec, and I would pronounce it a little bit different because he's from Croatia originally, but I think he's Americanized his name right now. So hopefully I said this correct. But we're living in a future, and here's one of those things that he's talking about, the same stuff that I have been talking about when it comes to real estate, of what we can expect. And so let's talk about let's read what he had to say, and then I'm going to explain some of the stuff of what I see as well. So, Shark Tank investor Robert, and I'm not going to butcher the man's name twice on the same show, said that basically people should not underestimate the long term effects of the coronavirus pandemic on remote working. We have been forced to change whether we like it or not. Yeah, people will go back to the offices, but work from home remote officers are the future. He's the founder of the Herjavec Group, which provides cybersecurity products, blah, blah, blah. There is no way I am renewing at 52,000 square feet. My offices will be smaller, and I think most people are going to reduce their footprint from an office perspective. Some larger companies across the U.S. have signaled they intend to expand their remote working policies. The move could also provide valuable cost savings after economic consequences from the pandemic. Facebook said Thursday that most of its employees will be allowed to continue to work from home throughout the end of the year. Twitter also said that everybody who wants to work from home will be working from home. So Nationwide Insurance recently announced it would be accelerating its transition to hybrid operating model. Morgan Stanley says that bank will need much less real estate. CEO of Commercial Real Estate Services investment firm CBRE said the companies that CBRE advises will expect to return to the office in some capacity, even as working from home increases. And you know what? CBRE kind of has to say that, y'all. They sell the stuff, they sell the commercial real estate. So they can't say, like, oh, people are going back. Like, that is going to kill them. So, what I'm basically saying is pay attention to what's going on. The reason that I am talking about this particular component is because, world is shifting, world is changing as we know it, and the work from home is going to become a real thing. Now we'll be allowed to go outside, we'll be allowed to go to the offices, but the vast majority of companies are going to go into this sort of weird hybrid model. Way back when, way back when, prior to the virus component, prior to the pandemic, many businesses, many managers were very afraid of, like, how do I manage people? People are not going to work, productivity is going to slump down. But everybody's reporting that productivity is actually picking up. And now they're going and saying, wait a minute. Why am I paying for this giant office space, building, whatever, when people are just as productive working from home? What they're going to look and say, if we cut that cost, that's a lot of money per month that we don't have to pay. That's out, right? Then they're going to look at their productivity and say, out of everybody that has performed, we have 10 or 20% of individuals who working from home didn't really work. We're going to eliminate those jobs. We're going to eliminate those people. We're going to actually find more people. And now we can compete globally, hiring people where they can live and work from anywhere. Now, that's sort of going to give a huge impact on the commercial real estate, where I think that that's going to go into the slumps, and it's not going to come back for quite some time until the prices go down and rent goes down and all of that stuff, and it gets reconfigured down the line. We're talking years, not months here, just to pay attention. The second thing that is also going to happen is on the homeowner slash employee side of things. Maybe you lived in a small apartment somewhere in San Francisco or Seattle or whatever, but now you're working from home and you're like, this was cute when I could go outside, I could go into the offices, I could do all of this stuff. But now I need a little bit more space to create an office, to create all of the stuff. So what we are going to see is that people are going to go, maybe, potentially, this is my argument, from expensive rent, expensive mortgage places like Seattle, New York, San Francisco, and move somewhere where they can still get what they want, but it's going to be cheaper. So, for example, I used earlier example of people from Silicon Valley have been actually moving to Austin, Texas for a while now, but I think we're going to see even larger exodus because, where it would take, say, $4,000 to rent a studio in San Francisco, that $4,000 in Austin, Texas can now get me like a 2-bedroom or 3-bedroom apartment or house. Well, now I can have a space where I sleep, space where my kid can sleep, an office space, that kind of stuff. So I think we're going to see exodus from these large, expensive things. And I still get this city feeling. I still get coffee shops, walkability, all the things that I wanted, that I enjoyed about living in San Francisco. So I think we're going to see smaller cities start to gain traction. And if you are smart and have been paying attention and sort of following me for a while, you know exactly where to start looking potentially for real estate. Here's my prediction. Smaller areas that still have really nice places, really cool things that people want to go, that, there is some ability to go to coffee shops, cool restaurants, walking around, that kind of stuff. Not that that's going to open anytime soon, but, eventually. Because people can work remotely, I don't have to live in the same city where I am working. I can go and now live in anywhere, actually, right? I can go and move to Austin, Texas. I can move to North Carolina. I can move to Florida. I can move wherever it is that I want. Idaho, Boise, Idaho has been picking up steam, big time steam. And, about 9 months ago or so, I talked about Boise, Idaho, and people have been looking at that stuff, and it's been doing amazingly well. So, things to think about, things to consider. This is beyond exciting to me. I hope you have enjoyed the show. Please make sure you join me tomorrow live at onedealaway.com/live. Until next time, stay forever money blessed. And do remember, you are only one deal away. Bye, y'all.